Profit First absolutely can work for sole proprietor businesses in Canada. But if you don't understand the differences between how an incorporated business is taxed versus a sole proprietor business, then the system could be working against you instead of with you. So that's what we're going to be talking about in today's video. How to install Profit First in a sole proprietor business the right way. But before we get into that, if we've never met before, hi, I'm Janet Mercredi. I help Canadian small business owners make sense of their numbers so that they can make better decisions with their time, their pay, and their profit. And on this channel, we talk about all the money stuff that most small business owners were never taught. Okay, so here's what we're going to be talking about in today's video. There are 3 nuances that you need to know so that you can install Profit First the right way in your sole proprietor business. And those 3 nuances are taxes, i.e. how they're calculated in a sole proprietor business, the percentages of Profit First, and how we tailor them to work for your business based on those percentages. First, let's talk about the taxes. So the thing with a sole proprietor business is that it gets added to your personal tax form on its own separate schedule called the T2125. Basically, it takes your profit and loss from your business, and whatever net income number is at the bottom of that profit and loss, that's what you're paying taxes on. And that number is calculated based on the 4 different tax brackets that we have in Canada. However, in addition to that, because you are a sole proprietor, the CRA also recognizes your business as both an employer and as an employee. So therefore, not only are you being taxed on your net income at one of the 4 different tax brackets, but you're also being taxed the CPP and the EI for both employer and employee. So that's why a sole proprietor usually ends up paying more than they thought. So how are we going to work this with our Profit First percentages? Well, to that, we're going to go to the whiteboard. Okay, so here we are on our whiteboard, and I have right now just column A and column B. In fact, I'll write that here, that you would probably read inside the Profit First book, right? Column A, $0 to $250,000. We're going to put in profit of 5%. The Profit First percentages, OCOP, are 50%. Tax is 15%, and OPEX is 30%. For businesses that are $250K to $500K, we're looking at 10% profit, 35% OCOMP, 15% tax, and 40% in operating expenses. Now in Canada, realistically, this 15% for tax generally does not cover what our sole proprietor businesses need set aside to pay for our taxes. On average, depending on the amount of net income in your sole proprietor business, you can expect to pay anywhere from 20 to 35% in taxes. And again, the reason for that is because of the personal income plus the employer and employee portions of the CPP and EI. I have seen it as high as 35% in my practice. Anything over and above that, even though Profit First has multiple columns of different percentages for up to $5+ million, I'm only going to be showing you the 2 column A and column B today, because if you are making more than $500,000 in your sole proprietor business, I do suggest that you go speak to your accountant and talk to them about incorporating. And only reason is because the sole proprietor business does not have as many tax advantages to use to lower your taxes payable, whereas an incorporated entity does. Now, not to say that you can't have a business that grosses $500,000 plus. You absolutely can. All I'm suggesting is, if you want to look at different strategies available to you for the tax side of things, you might want to look at incorporating when you reach that level. So enough about that. Here we are from the 0 to 250K. Now, where I would go with this when I'm working with a client in the sole proprietor business is the profit is going to stay at 5%. And I would start the taxes at 20%, because that's usually the bottom line as to how much taxes you're going to have to pay because of the EI and the CPP. Now, before I say that OCOMP should be 50% and OPEX is normally 30%, right? If we add these all up, they need to equal 100%. And so generally, the extra 5% that we have added to the tax, we either take it out of OCOMP, so our OCOMP becomes 45%, or we take it out of our OPEX, and our OPEX becomes 25%, and our OCOMP stays at 50%. Keeping in mind, here's another important nuance. Because you are a sole proprietor, you don't get taxed on the amount of money you physically withdraw from the business. So therefore, when you withdraw their 5% in profit and you withdraw your 45% in owner's comp as your pay or salary, even though you can't be on payroll as a sole proprietor, you're taking it as a draw. That's your money that you don't have to claim, because as a sole proprietor, you're getting taxed on your net income, not on the amount of money you withdraw. So therefore, you're still making up your 50% here by taking 45 OCOM and 5% in profit. And our taxes are at 20%. Now, again, we're not going to know if 20% is enough for you until you actually file your personal tax return. But it's a good place to start. This is our baseline. And then after a few years of filing your tax return and you start to notice that maybe you should be putting aside a little bit more, then this 20% could inevitably become anywhere in between the 20 and the 35. So you're going to adjust this as the years go on. Your operating expenses, now obviously, you want to run your business as lean as you possibly can. So 30% is a very good number for a sole proprietor to run their operating expenses. But if this can be lower than 30, then great on you. That means that this is lower, you can raise this number, and maybe you can take more here in the owner's compensation. Okay. So on the next column, our 250 to 500K, same idea. We're leaving our profit at 10%. I'm going to skip OCOMP for right now. Usually in this range, you could probably bank on our baseline at least being 25% because we're making more money, right? We're making higher gross. We're therefore paying more expenses. So therefore we have a higher net income at the end of the year. What I would suggest here is we leave our OPEX at 40%, but then we subtract from our owner's comp in order to make our 100%, right? So therefore, instead of our owner's compensation being 35%, it's going to be 25%. And I know you might be saying, well, that means you're getting paid too little. Here is the reality and the logic behind why the owner's compensation goes down with the more money you make in your business. It's because this is based on under 250K, you as a sole proprietor are doing absolutely every job inside your business. You're doing the marketing, you're doing the social media, you're delivering the service to the clients, you're doing the billing, you're doing the bookkeeping, you're doing it all. So therefore, all of those jobs take money. And so we want to reward you by getting paid for those jobs. When you start making more money and you're at the 500,000 range and up, generally you should be hiring somebody at this point. So your jobs are not as heavy. You might have outsourced the bookkeeping. You might have outsourced the social media. You might have hired a VA to handle your email. So therefore, that job is no longer yours, which then can go into your operating expenses to pay that person. So then you can take less OPEX and more reward of your profit. And I've talked about this in other videos. Profit is your reward for owning your business. Owner's pay is your salary paycheck for doing the jobs inside your business. Okay. So when I'm looking at a sole proprietor business, this is how you're going to install your profit first the right way. So yes, these are our general percentages for these two columns. We got the 5, the 50, the 15, and the 30. However, in Canada, because our tax rates are higher in a sole proprietor, because you're paying not just your personal tax return, but you're also paying the owner's compensation of the EI and the CPP, both employer and employee, you automatically have to gross it up. So that's what our whiteboard is telling us, and that's how you install the profit first system in your sole proprietor business. So that's what I have for you in today's video. If you like this video, I encourage you to like and subscribe to my channel so you don't miss any upcoming videos. And again, my name is Janet Mercredi, and I'll catch you in the next video.